Hello, everybody. Kirk Spano. It is Saturday, August 6th, and a couple of days late getting this webinar out. So, why don't we get started with the Global Trends ETF, and we'll move over to these secular trends that it applies to in just a minute. I'm not going to show the entire portfolio here, but you all have it if you are a subscriber. And I talk about the various ETFs that we want to use to overweight the better parts of the economy. We have both core and satellite positions. You could think of those as strategic versus tactical. So we have our strategic core, we have our tactical satellite positions. Now, one of the things that I would discuss here is that this is all based on the major secular trends that are out there. So when we think about what's going on in the economy, we need to understand where the biggest money is going and where the biggest money is leaving. So when we think about the big picture, we have aging demographics, which are deflationary, global debt, which is deflationary, fourth industrial technological change and digitization, which is deflationary, the clean energy transition and decarbonization, which is inflationary for the next several years, but then will become deflationary as we have a surplus of energy again. Multipolar geopolitics can be either inflationary or deflationary. When we are in an era of increasing globalization, that typically is deflationary. And when we are in a period of decreasing globalization, that is typically inflationary. Now, I know that there has been several million jobs lost to other economies, but the jobs that have come back in their place have always been better jobs for the most part and higher paying if you're willing to get the skills or able to get the skills and the education that you needed. Over the last 40 years or so, and really set up largely by Nixon and followed through on by President Reagan, we saw a big shift in the economy, which was deliberate, and it was a globalization theme. So while we lamented jobs going to China or somewhere else in Southeast Asia or other places, the reality is what came back was typically better. But people don't like change. And I'm going on about this a little bit because I think it's important that you think through really what is good for you and what is good for the world. And this deglobalization that we're going through is probably bad, both economically and from the standpoint of peace. So if we are damaging peace and prosperity by reducing the amount of globalization, then we probably want to rethink. Henry Kissinger recently warned President Biden that we should not want perpetual confrontation with China. And while that is in both of our hands, not just ours, diplomacy and understanding the needs or the desires of others and the reality that everybody on the planet just wants to be happy and feel unthreatened could go a long way. So when we think about inflation, it really is important that we think about the geopolitics because this is the wild card. This is where we can have an impact, something that we can influence at the voters' booth, something that we can influence with our behaviors. Finally, the last thing here, emerging markets, that's really the only place where there is long-term inflationary pressure as millions and millions and really a couple billion more people still have to enter the global middle class. So when we do our asset allocation, we want to understand that the big boogeyman here is probably deflation unless there's a lot more global conflict, which is a choice. And if we choose more conflict and less global cooperation, then we'll probably get more rounds of cyclical inflation and hopefully not war outright, but there is the potential for war. So we have to be careful there. When I build these portfolios, I can't really build them for the idea that we're going to have perpetual conflict because ultimately perpetual conflict leads to collapse, even if you get an inflationary spike. So I'm not planning for an inflationary spike and then a collapse in the global economy. At that point, I'm just going to be somewhere in the northern woods of Wisconsin, hoping that the bad stuff doesn't get to me. I don't take the apocalyptic view, even though there are scenarios for an Armageddon zombie apocalypse across the board. They are unlikely, but we have to remain vigilant that they don't hit us, that it doesn't happen. And our behavior politically is important in this regard. So again, when you think about what is good for you and what is not good for you, think through whether it makes sense to be perpetually in conflict with the other big nations, particularly China and Russia. I believe that Russia is probably going to just get rid of Putin at some point because they have taken a massive economic hit. And if China realizes, hey, we got it pretty good if we just don't rock the boat too much. So if we can settle the Taiwan issue and Russia can settle the Putin issue, we start to reglobalize or at least find a level plane. And peace and prosperity, which has been increasing since World War II, right? There's fewer people at war. There's more people who are prosperous, educated, better healthcare, higher standards of living than ever before. So when everybody has this negative view of the world, I just take a look at some of the statistics. And what we know is that a lot of things are getting better, but they are largely driven by technology and by people entering the global middle class. When we build our asset allocation, we have to think about that. Can we be apocalyptic? Can we be inflationistas? Can we stamp our foot and pound our chest and sing funny songs and chant about the collapse of the dollar? A chart that I've showed you over and over again is just clearly not true. We could, or we could take a look at the long-term trend since the 1950s and the way the curves work, how the math shapes up. We could realize that the fourth industrial revolution and decarbonization are probably great places to invest. I think that biotech is coming of age. There's been two major advancements in the last 20 some years, not only the decoding of the genome and now finally applications of it, but artificial intelligence in the last year or two has completely decoded and built structural models of every protein in our body. The age of cheaper biotechnology that can cure almost everything is coming, which means the kids born today are going to live to be 120. And they really probably are, and they'll be healthy. That's an opportunity that I have not been involved with lately. And as you all know, I made most of my first hunk of money on a biotech stock. But the last several years, biotech has been churning. But what's coming next in biotechnology is something that we're going to have to keep an eye on. So you'll find that in our asset allocations sometime this fall. Not yet, but we're getting close. And I want you to know how to use these portfolios. So I wrote a new Using Global Trends ETF article for you. It's based on the old article, but this one's updated. And I simplified it quite a bit, which is what I think everybody really wants. And I discuss your cash range and how you want to manage your cash. Now, I have been relatively heavy cash for my entire career. I typically carry between 15 and 20% cash in my portfolio. And I got this basically by watching Warren Buffett. Berkshire Hathaway often carries a lot of cash, and they do it for optionality. And what is optionality? Optionality is basically having the cash to be able to strike when the iron's hot, right? It's the ability to buy that big correction because you have cash on hand. If you have worked with me before, you know that I use cash secured puts, which is something that Warren Buffett has used. I got that idea from them too, really about how to implement them. I was trained on options when I was a young pup in the industry by somebody who helped actually write the exam that brokers took back in the 70s and 80s. I use cash secured puts a number of ways to put my cash to work in the short term while I'm waiting for those big opportunities. I will write a series of cash secured puts over a number of months so that my cash is earning way more than the money market rate, almost an equity-like return. And every month, a hunk of cash becomes unencumbered, meaning that it's not holding anything. And that cash is available should I need it to buy something that got super cheap. And over the course of 3, 4, 5 months, I'm recycling these option positions. One expires or is assigned, and then I have cash. If something gets assigned to me, it's because I wanted it in the first place and I found a way to get it at a cheaper price than it was a little while ago. So while I carry a heavy cash load waiting for the giant opportunities, I have still basically beaten the markets pretty handily because what I do buy tends to be high beta. I talk about that in this article as well. I invest in high beta stocks and high beta ETFs because they give me more opportunities to buy low and sell high. When they sell off more than they should. And when they rally more than they should because of FOMO. So I get big sell-offs to buy and big rallies to sell into. And I scale out because I scaled in earlier. or I scale in so that I can scale out later. So when you think about what your typical cash allocation is going to be, what I have come to is that I typically have what I would consider a moderate cash allocation, pushing 20%, but I invest in aggressive things. And I think that's a much better way to do asset allocation than the modern portfolio theory that's out there that basically has you invest a little bit of everything. I would rather invest in the best stuff and hold a little bit of cash for choppy periods in the market or for just big sell-offs. Because during the choppy periods, certain things get cheap. And during the big sell-offs, everything gets cheap. So that's my approach. You don't have to use it. But I think that if you carry a little extra cash, but you have more aggressive investments, you'll do better over a long period of time. And it doesn't matter if you're retired or younger, but it just doesn't matter. Because if you're older and carrying extra cash, you're A-okay with that. So long as you're getting the income you need and the growth, because you're probably going to live to be pretty old. A lot of people who are 70-ish think they're old. You're not old. My grandmother, who we're putting into assisted living in a couple of weeks, is 93. For her generation, she's old. People who are 70 today, if you eat right and get, walk around and get some exercise, probably going to live well into your 90s. If not, crack 100. If I do that, I should crack 100. My grandchildren should live to be way over 100, 110, 120. Combinations of all these things that are coming. Cleaner planet, better medicine through biotechnology, less stressful work careers because technology is taking a lot of the burden, whether it's robots lifting the heavy stuff or AI making discovery and work easier. I don't think people realize that if we don't screw up here in the next 10 to 20 years, a lot of the great stuff that you've seen in sci-fi, and I don't mean the wars and the Star Wars and, the Klingons and, all the different wars that they have in space, but I mean, think about the way you could live, the way your children and grandchildren, great-grandchildren could live if everything was a little easier. We started reading more literature again. We started helping our neighbors again because we have the time. We don't have to work 60-hour weeks anymore. We can work a 40-hour or 30-hour week. Allocate time to being happy, putting around in the garden, whatever it is you like. Doing more for those who are disaffected as fewer and fewer people become disaffected. Painting something nice, creating artwork. That is the way that the world is really going if we don't screw it up. So I'm investing in the things to make the world better because it's coming. So long as we don't screw it up, we'll see what the millennials do because they control really not just the United States electorate at this point, but really they're going to control the fate of the world. And if we keep moving in this direction of more discovery of the world around us, right, because the millennials travel and they're trying to become worldly, and we let technology improve our standards of living, and we decarbonize so that we can first flatten the damage that we've done and then improve it over a century. That's a lot of good stuff. Take a look how Captain Picard lived in retirement. Yeah, if you're a Star Trek person, you know what I'm talking about. He had his vineyard, his nice house, a couple people he hung out with. That's the way the world is going. There's plenty of space. Elon Musk isn't wrong that we could probably double the population and be okay, but if we don't, if we stay in that 8 billion range for a long time, which is kind of the way the curves are working, think about all the space on this planet, given the number of people there are right now. Think of all the open space on this continent, right? We don't have any problems with overcrowding. We're going to have to move some people around because we screwed up bad enough to raise the ocean sea levels. But if we build it better over the next 20, 30 years, boy, oh boy, things look good. And I need you to think that way because the negativity hurts your investment returns and it stresses you out. It makes you unhealthy. So this positive mindset that I have had to talk myself and train myself into, and luckily for me, I believe in the numbers and understand them. I've gotten to that point over the last 7 or 8 years, maybe since, maybe even longer. I've been moving in that direction. I remember this guy who trained me on the option trading. He said, Kirk, I can't live a healthy life if I'm always thinking negatively. And that had an impact on me. That was 20 years ago. So as easy as it is to be negative with the things that get thrown in your face on the internet and on TV and the news, the reality is that life has gotten quite a bit better since World War II. And it's going to keep moving, and that curve is bending up faster. Again, unless we screw it up. So when you invest, you need to think about what's getting better Where's the big money moving to make it better? What are the super rich doing with their money? Because they really drive everything, right? They control 70, 80% of the money. So when those big piles of money are moving, you have to pay attention to that. Not the, oh my God, something bad happened again. Think about the solutions, not the problems, because the solutions are out there and there's a lot of money to be made in the solutions. When I build a core and tactical portfolio, I'll have my more diversified investments and I'll have my tactical investments. And there will be money going into this genomic revolution. I've looked at all the ETFs for biotech, and as volatile as this is, you can buy the dips on this. Pretty interesting. Maximum allocations is the way that you want to get, or the direction you want to get if you get the opportunities. The current allocation, this is important here. The current allocation that I have in my chart, you can get to those positions this month. Basically, dollar cost average or average in over 2 or 3 purchases in the next month. Buy the dips essentially. And sometimes we'll get an opportunity to go, max all in on something. It has to do with pricing, a little bit of luck, right? Don't discount luck. When you get luck, use it. When you get good luck, use it to your advantage. When you get bad luck, move on. I will give you trade alerts. I have 5 different investment strategies for clients of mine, but that doesn't mean that you have to wait for the trade alerts. When I give you this information, this research, and point you in the directions that I'm going and bring you to the water, sometimes you have to drink at your own pace. You have to do you, but I'm trying to give you the tools to build these portfolios in a way that reflects you and moves you more in the direction of the solutions and where the big money is going, because that's how you win. Somebody asked me about methodology. Why do I build the asset allocations the way I do? Well, I start with the asset allocation of the S&P 500. And if you take a look at SPY, one of the reasons I tell you not to invest in SPY is that its asset allocation is wrong. Technology is over 40% of the global economy and the US economy, and yet it's only 28.38% of SPY. There are legacy positions in the S&P 500 that don't reflect the current economy, not only the size of the economy, but the growth in the economy. That's why QQQ, which is about a 24, 25-year-old ETF, has beaten the S&P 500 pretty much over every time frame longer than 3 years. There are little cycles where the S&P 500 outperforms. I think we have just finished one, or we're near the end of one. But those little cyclical periods where old man value wins for a little while are few and far between, and they're short-lived. What wins is advancement. When you take a look at industry that applies technology well does really well. So I'm heavier in industrials and information technology, consumer discretionary. I own virtually no financials other than some of the new fintech stuff. Communications right now, actually, I'm heavy in, and this will be cyclical. When all the streamers and all the beaten up stocks here get back to normal valuations, I pretty much have nothing in consumer staples. My energy is all tied to decarbonization, and I'm way over 4%. Right? Our biggest investment is an energy investment, but it's not an oil driller. It's a biofuels and carbon capture company. What is it up 40, 50% in the last couple of weeks off the bottom that I pounded the table on for months and months for people to buy? My utilities are the clean energy utilities, probably about that asset allocation. I get them incidentally to some of my clean energy ETFs. Real estate, we're way over 3% in real estate because we build our own REIT basket. We own about a half a dozen REITs. And then materials, there's only a couple that I like. So for some of these small things, right, we'll never own an ETF in financials. We'll never own an ETF in staples. Probably never own an ETF in utilities, real estate, or materials. Energy would be clean energy. QQQ covers consumer discretionary, IT, healthcare, and communications and industry, stuff on the left half here. But by dramatically underweighting certain things, then overweighting others with reference to SPY as being the benchmark, because that's everybody's benchmark, we can beat SPY pretty easily by just ignoring the crap, financials and consumer staples, and throwing that money over here. So that's what I do. And everything is based on valuation and then overbought or oversold signals. When we take a look at SPY, we can see here on a monthly chart, the RSI is right in the middle. SPY could go up or down right now based on the technicals. And I think that this rebound means one more digger here. You'll notice that even on the monthly chart, it's very rare, going back all the way to the 90s, that SPY gets completely oversold on the monthly chart. So we probably don't have much more to go down on SPY. Could we get a Armageddon zombie apocalypse down here? We could, but it's unlikely. If we do, it'll have to do with something that happens internationally. We don't have any of the negative things. We don't have the hypervaluations of 2000. We don't have the leverage of 2008. If there is a massive oversell, which means everything's dirt cheap, it's because something happens internationally. So that's what we keep an eye on. Even if you look at this on a shorter time frame, the weekly charts, right? Almost any time it gets down here, you buy it. So it got down here, and now we're having this rally over the summer. If you take a look at the June stock plug and play, actually, it might be this one. I expect a face ripping rebound rally soon. July, maybe. I mean, seriously, come on. I get a clap for that. That's pretty good. That's exactly what we got. So what I think whether you're looking at SPY, probably expect a little bit more correction or a retest to the bottom. Then I think we see a multi-year presidential rally, presidential cycle rally. It's coming. It's going to be record-breaking, I think, because eventually the Fed backs off because the inflation is cyclical. Still think that happens this autumn, which is what I've been saying since February, March, January, first quarter sometime. Because again, I don't believe that the inflation is long-term in nature. Can you call it transitory? It depends how you define transitory. I think if transitory is a couple of years, yes, you can call it transitory. If you think transitory is like, 6 minutes, then you can't call it transitory. But the reality is that we are in a transitory or cyclical inflation period that probably starts to go away very soon. That's even better for QQQ because it's heavier in tech. If I'm right, in 3, 4, 5 years, somewhere not too distant future, 2026, 7, 8, right in there, we'll be talking about deflation again. So between now and then, we have one set of opportunities. When we start talking about deflation again, there'll be a scary moment, but there'll be a new set of opportunities as well. So we want to shift our asset allocation ahead of time for the opportunities that are coming when everybody else is scared. And we want to ride the FOMO rallies because we're already in. And as FOMO pushes things up, we can sell at higher and higher prices. So time and inflation fixed valuations here, you probably don't get back till 2024 to the highs. But then FOMO takes over again as everybody gets giddy. We get this stupid rally into the election. And probably through, January at least of 2025. Now, this is pretty micro in nature to me, but if you turn these into wiggly lines and the shape ends up being roughly like that, we should get pretty close. And if we overweight the right things, we're going to do really well. Now, I wouldn't encourage anybody to be 100% ETFs if you have the stomach to own a basket of 20 to 30 stocks, even if that's only for a quarter of your portfolio. Teeny tiny bites. And I would encourage anybody who's 100% in funds to at least peel off a quarter of your money for stocks, because there are some really good companies out there that are in the small and mid cap spaces that are just beat the heck. And you can't buy those small cap indexes in particular. There's only one mid cap fund that I really just keep coming back to because there's a lot of those small companies and most of them aren't going to do well. But if you can pick out a basket that is going to do well, they're going to do so well. Peter Lynch parlance, few big winners offset everything else and then some. So if you're 100% ETFs and funds, 401k plans, I get it. But I think that if you can peel off a quarter of your fund portfolio and put it in the stocks, you're going to do even better, especially if you think like a long-term investor instead of a short-term trader. Because we know that 80% of short-term traders lose, and the really big money is made in buying cheap a few years earlier than the rest of the world sees something that's going to happen. And seeing the future is hard, but I started out with positivity today, and I'll come back to it. If you see the world is getting better because there's solutions driven by big money coming, you're going to do better. If you are afraid, you feel like the world is getting worse as you sit in your pool and have a drink, which somebody yesterday was doing, talking about how bad the world is while she sat in the pool and had her drink. You start to realize, maybe it ain't so bad. Maybe I should invest like the rich people who kind of know something about money and managing things. We don't have to talk about evil or not evil. We just talk about, hey, you got a lot of money. You probably have figured out how to move it around a bit. When we think about how things are getting better and how we're solving problems, and just keep making things better generation to generation since the dark ages, think that through. We'll have a bad decade here and there, but generation to generation, Every generation has lived better than the prior one for a very long time, for centuries, even with the hiccups. So think about what the solutions are and realize certain things are going to do even better. And just avoid the things that are dying. If you just avoid the things that are slowly dying, like oil, you're going to do really, really well. All right. I will catch you on Monday for our stocks of the week, which is going to be a huge update. Take care.